Hello everyone, welcome to Tesla Daily News. Today is June 3rd, Wednesday, and the following is the latest Tesla news. According to market data, Tesla stock opened at $418.22, traded between a low of $413.65 and a high of $424.42, and closed at $423.74 on volume of about 37.5 million shares, versus the previous close of $415.88. In simple technical terms, strong up day, testing recent resistance on rising volume. For investors, this move suggests renewed buying interest after recent volatility, with the stock outperforming many peers as sentiment improves around Tesla's growth prospects, AI initiatives, and the anticipated SpaceX IPO that could further spotlight Elon Musk's broader ecosystem. According to the Frankfurter Allgemeine Zeitung, Elon Musk is now on the verge of becoming the world's first trillion-dollar individual, driven by his stakes in Tesla, SpaceX, and XAI. The report traces his path from the early Zip2 and PayPal days through the roller coaster swings in Tesla's valuation, the Twitter acquisition, and the recent recovery in his wealth. It highlights that his net worth is currently estimated between roughly $740 and more than $830 billion, depending on valuation methods, and that the planned SpaceX listing on June 12 could push his fortune over the trillion mark if the company reaches a targeted valuation of up to $2 trillion. For Tesla investors, this matters because Musk's financial firepower and public profile amplify Tesla's strategic flexibility. A richer, more liquid Musk can support capital-intensive projects, weather downturns, and keep Tesla central to a broader technology platform spanning rockets, AI, and robotics. At the same time, the article reminds readers that his fortune has been extremely volatile, falling sharply in years when Tesla's share price or his political and social media activities triggered backlash. For enthusiasts, this underlines both the opportunity and the key person risk. Tesla's destiny remains tightly bound to Musk's decisions, reputation, and time allocation across his ventures. According to Reuters, Tesla has recorded a strong rebound in European sales, with significant gains in several key markets after having lost nearly half of its regional market share back in 2025. In France, registrations reportedly jumped more than six-fold year-on-year for the month, and Norway saw an increase of nearly a third, while smaller markets such as Denmark, Spain, Portugal, and Sweden posted rises ranging from double-digit to triple-digit percentages. The report notes that Italy is a mixed picture, with May registrations down but year-to-date sales still more than 15% higher than the previous year. Analysts quoted in the article argue that Tesla is riding the overall growth of the European EV market even as its market share is under pressure from fierce competition, particularly from Chinese manufacturers. They point to Tesla's aggressive pricing strategy, strong manufacturing efficiency, and especially the Model Y's appeal in the SUV segment, offering what many perceive as a compelling balance between price and driving range. For investors, this suggests that while competition erodes relative share, Tesla is still growing absolute unit volumes and remains highly relevant in Europe's transition to electric mobility. For enthusiasts, the message is that the Model Y continues to be the workhorse and brand ambassador in Europe, even as political controversies around Musk and a lack of completely new models have weighed on sentiment. According to Goulburn Post reporting by Tim Gibson and coverage in the Northern Territory News, Tesla has just delivered a record month of sales in Australia, marking a major milestone for the local EV transition. Tesla sold around 6,433 vehicles in May, the highest single month ever recorded in the Electric Vehicle Council dataset. Combined with Polestar's performance, the two brands delivered nearly 6,700 vehicles, representing a very large rebound compared with April and a strong jump versus May of last year. The surge was overwhelmingly led by the Model Y, which accounted for roughly 5,605 deliveries and about 80+% of all vehicles captured in the Electric Vehicle Council's report. The Model 3 also posted a significant increase compared with the same month a year earlier. The Electric Vehicle Council's chief executive emphasized that rising fuel prices and geopolitical tensions, including the conflict impacting oil markets and shipping routes, are pushing Australian buyers to seek alternatives to traditional combustion engines. With crude trading near the $100 per barrel level and temporary fuel excise relief set to expire at the end of June, electricity-powered transport becomes relatively more attractive. For investors, this data is a real-world confirmation that high fuel costs and policy shifts can accelerate EV adoption and directly boost Tesla volumes in price-sensitive markets. For enthusiasts, it illustrates how the Model Y has become Australia's go-to EV for families, especially with the addition of the new 6-seat Model Y L variant designed to broaden the brand's appeal. According to the same Australian reports, Broader EV market data from VFACTS shows that battery electric vehicles have climbed to roughly 1 in 6 new vehicle sales nationally. Tesla's country director for Australia and New Zealand credited the strong performance to both loyal repeat customers and an expanding base of first-time Tesla buyers, along with a product line tailored for local family needs. The eastern seaboard states are leading the transition. Queensland, New South Wales, and Victoria have each posted year-to-date growth rates exceeding 60% for combined Tesla and Polestar sales. Year-to-date volumes across the two brands are up more than 50% compared with the first 5 months of the prior year. For investors, this reinforces a key thesis. Once charging infrastructure reaches a basic maturity and fuel prices bite, EV penetration can move quickly from low single-digit shares to double-digit territory. Tesla's early presence and brand strength allow it to capture a large portion of that growth. For enthusiasts, it suggests that owning a Tesla in Australia is becoming mainstream rather than niche, with greater social acceptance and support infrastructure. According to the Goulburn Post, Tesla has introduced a new retractable sunshade accessory for the Model Y in China, addressing one of the most common comfort complaints from owners: cabin heat from the large glass panoramic roof. Priced at 1,499 yuan, roughly a few hundred Australian dollars, the manual sunshade is trimmed in the same fabric as the factory headliner and uses a roller-type design with an integrated frame and metallic handles. Installation is designed to be simple for do-it-yourself owners, though Tesla also offers professional fitting for an additional fee. The company notes that the accessory has undergone full vehicle airbag deployment testing and multiple road tests to ensure safety. At present, this factory sunshade is targeted at 2025 and later Model Y vehicles in China, but Tesla Australia has indicated that it expects accessories like this to eventually be available in other markets, albeit with some delay due to the strong global demand for the latest Model Y variants. For investors, this may seem like a minor product tweak, but it illustrates Tesla's growing attention to user comfort and regional preferences, which can improve customer satisfaction and reduce the appeal of third-party aftermarket solutions that might otherwise capture revenue and control over the customer experience. For enthusiasts, especially those in hot climates, it signals that Tesla is listening to feedback about interior heat and is willing to provide an integrated, tested solution rather than leaving owners to improvised fixes. According to Taiwan's Liberty Times, Tesla has officially ended production of its flagship Model S and Model X, with the final units rolling off the line at its California factory in mid-May, effectively closing the book on models that defined the brand's early success. Engineering Vice President Lars Morvey explained in an interview that the key reason for retiring these vehicles was not collapsing demand, but the aging platform architectures underlying both models. The Model S platform, originally developed around 2008 and launched in 2012, has received many software and hardware updates over the years, but its core body structure has not been fundamentally redesigned. As global safety regulations and crash test standards from agencies such as Euro NCAP and the Insurance Institute for Highway Safety have become more demanding, maintaining top-tier safety ratings on that legacy architecture would require enormous engineering investment. Morvey said that keeping Model S and Model X among the very safest cars on the road would mean essentially re-engineering the vehicles from the ground up, which did not fit Tesla's current resource allocation strategy. According to the same Liberty Times report, another major factor was the suitability of the older platform and electronic architecture for Tesla's long-term full self-driving vision. Early generation designs are not optimized for the dense computing, sensor integration, and redundancy needed for fully autonomous systems. In parallel, Tesla is heavily focusing capital and engineering talent on new initiatives such as the Optimus humanoid robot, which the company sees as a potential next-generation growth engine. To scale Optimus production, Tesla needs to free up factory capacity and internal resources, making it difficult to justify the continued low-volume production of high-end sedans and SUVs on outdated platforms. For investors, the retirement of Model S and Model X is a clear signal that Tesla is willing to end legacy products that are no longer aligned with its long-term technology roadmap and capital efficiency goals. The shift frees capacity and attention for more scalable products, next-gen platforms, and high-margin AI-driven services. For enthusiasts, especially longtime fans who view the Model S and Model X as icons, the decision is bittersweet, but it may also raise expectations for future flagships built on truly modern architectures. According to Grist, a new analysis from insurance comparison platform Insurify shows that electric vehicles in the United States remain significantly more expensive to insure than comparable internal combustion cars, with important implications for Tesla owners. On average, EVs cost about $3,159 per year to insure, nearly $1,000 more than gasoline cars, representing an insurance gap of roughly 40+%. The difference varies widely by state and model, with Washington, D.C., listed as one of the most expensive markets and Maine near the low end. Luxury electric models from brands like Tesla, Mercedes-Benz, and Audi often face premiums exceeding $4,000 annually, while EVs from Volvo, Chevrolet, Ford, and Hyundai can be somewhat cheaper to insure. Insurify's data indicates that lower-cost insurers for EVs currently include providers such as Lemonade, Root, and Geico. For investors, this insurance gap is an important headwind. It extends the payback period for buyers and could slow adoption compared to what pure fuel savings calculations would suggest. For Tesla enthusiasts and prospective owners, it means that the total cost of ownership must account for higher insurance, not just savings on fuel and maintenance. According to experts quoted in the GRIST report, one primary reason for the higher premiums is that EVs generally cost more to repair, with claims data showing average repair costs around 15% higher than for traditional vehicles. Batteries are expensive to fix or replace and require special handling, and EVs often contain dense, complex electronics that raise labor time. Structural design also matters. As an example, the report describes crash test analysis comparing gasoline and electric versions of the Ford F-150 pickup. The internal combustion model's engine helps absorb impact in frontal collisions, while the electric Lightning variant, lacking that mass, requires extra structural reinforcement in the front, which is more costly to repair. Additionally, manufacturers may require labor-intensive steps such as removing the battery pack before repairs, further raising costs. Yet interestingly, in insurance pricing, the Lightning and conventional F-150 end up with similar average premiums, which analysts attribute partly to different driver demographics, including credit profiles and driving records. More affluent EV buyers may have cleaner records and fewer claims, nudging rates lower than repair costs alone would imply. According to the same article, several broader factors influence regional insurance price differences, including climate risks like hurricanes and floods, theft rates, population density, regulatory environments, and the maturity of local EV repair infrastructure. International comparisons show that the EV insurance gap is not unique to the United States. The GRIST report cites Bloomberg and YEF findings that the cost differential between EVs and combustion vehicles is similar in the United Kingdom and Germany, and even wider in France, though US EV owners still pay far more overall than European drivers. Tesla's Model Y is mentioned as a particularly extreme case where American insurance premiums are nearly 3 times those for the same model in Germany. There are, however, early signs of modest improvement. From 2023 to 2025, the US EV insurance gap widened significantly, but this year it has narrowed slightly, and for vehicles built in the last 2 model years the gap is much smaller, around the high teens in percentage terms. Part of this is because overall auto insurance prices have cooled, but it also reflects a gradual normalization as EV batteries become cheaper, more data becomes available for actuarial models, and more insurers actively compete for EV customers. According to low progress in France, a recent fatal crash involving a Tesla Model Y in Florida has once again drawn attention to the company's advanced driver assistance systems, particularly Autopilot. The incident occurred on the evening of May 27 near Wesley Chapel. Police reports indicate that the Model Y was operating with Autopilot engaged when it left the roadway for reasons that remain unclear. The vehicle reportedly struck an electrical utility structure before ending up in a pond. The 87-year-old male driver later died from his injuries, while his 75-year-old passenger was injured but survived. Investigators emphasized that the posted speed limit in the area was around 30 miles per hour and that the cause of the departure from the lane is not yet known. Tesla's driver assistance offerings include Autopilot, which combines adaptive cruise control and lane-keeping assistance, and a more advanced system that adds automatic lane changes, smart parking functions, and responses to traffic lights and stop signs. The Florida Highway Patrol has launched an investigation to determine what role, if any, the driver assistance system played in the crash. According to the same French coverage, this tragedy fits into a broader pattern of scrutiny around Tesla's automated driving features. Tesla has long maintained that Autopilot and its more advanced system significantly improve safety when used correctly and when drivers remain attentive with their hands on the wheel. However, regulators and courts are increasingly examining whether the branding, marketing, and real-world performance of these systems are aligned. The article notes a recent U.S. federal court decision that held Autopilot responsible in a separate fatal crash from 2009 in Key Largo, where a Model S collided with a stationary SUV, resulting in the death of a 22-year-old woman. For investors, such incidents represent a material legal and reputational risk. Large jury awards or regulatory penalties could affect profitability, and recurring negative headlines may shape public perception of Tesla's safety record and its path toward fully autonomous driving. For enthusiasts, these events are a sobering reminder that current Tesla systems, despite their impressive capabilities, remain driver assistance tools rather than true self-driving, and that careful, attentive human oversight is still essential. According to Finanzen and other financial media, Tesla's Chinese rival BYD has posted its first month of vehicle sales growth in about 8 months, sparking a sharp upward move in BYD's share price and renewed investor interest in the broader EV sector. While the article focuses primarily on BYD, it has important implications for Tesla. BYD's resumption of volume growth after a period of stagnation or decline indicates that demand for electric vehicles, particularly in China and emerging markets, remains robust when pricing is right and product lines are refreshed. The market interpreted BYD's data as a signal that talk of a deep, prolonged EV demand slowdown may be overstated. For Tesla investors, this is a double-edged development. On one hand, a healthy BYD underscores intense competition in China and, increasingly, in Europe and other regions where Chinese brands are expanding aggressively. This adds pressure on Tesla's margins and forces continued innovation in both technology and cost structure. On the other hand, strong numbers from a major rival also confirm that the structural shift toward EVs is intact, supporting the long-term growth story for the entire sector. According to the same coverage, the reaction in BYD's stock demonstrates how quickly sentiment can turn when investors see evidence of demand resilience. Analysts highlight that Chinese manufacturers benefit from tight vertical integration and aggressive cost control, allowing them to cut prices rapidly when needed. Tesla has responded over the past couple of years with its own series of price cuts and efficiency gains, but the landscape remains highly competitive. For Tesla enthusiasts, the rise of BYD is a reminder that the EV revolution is no longer a one-company show. Globally, buyers now see a wide range of electric options at different price points and from many brands. Tesla's challenge will be to maintain its technological edge in software, charging network, and autonomy while also offering compelling value in a market where rivals continually narrow the gap in quality and range. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and share it with other Tesla investors and enthusiasts.